This is every way the government and financial institutions track your money, and most people have no idea how much they're watching. You deposit $10,000 cash at your bank. Seems normal, right? Within 24 hours, your bank files a report with the federal government. Your name, address, social security number, and exactly where that money came from. And here's the crazy part, you never get notified. They just report you automatically. But that's just the beginning. What I'm about to show you is the massive surveillance network, tracking every dollar you spend, every transaction you make, and every bank account you open. The $10,000 rule, the tripwire everyone knows. Let's start with the one everyone's heard about, but nobody really understands, the $10,000 reporting rule. You walk into a bank and deposit $10,000 or more in cash. The teller smiles, processes your deposit, everything seems normal. But behind the scenes, that bank is legally required to file what's called a currency transaction report, a CTR, with the Financial Crimes Enforcement Network, which is part of the Treasury Department. This report includes your full name, address, social security number, occupation, the exact amount deposited, the account number, and a description of the transaction. It goes straight to the federal government within 15 days. And here's what freaks people out. You don't get notified. There's no email saying, "Hey, we reported you to the feds." It just happens automatically. Now, this rule was created back in 1970 with the Bank Secrecy Act to catch money launderers and drug dealers moving huge amounts of cash. Makes sense, right? If someone's depositing $50,000 in cash every week, that's probably worth looking into. But here's where it gets interesting, and this is where people try to get clever and end up in way more trouble. You might think, okay, I'll just deposit $9,500 instead. That's under $10,000, so no report, right? Wrong. That's called structuring, and it's a federal crime. The second you deliberately break up transactions to avoid the reporting threshold, you've committed a felony that can get you 5 years in prison and a $250,000 fine. And banks are specifically trained to watch for this behavior. It's like that scene in Breaking Bad where Walter White is buying his son a car and realizes he can't pay in cash without triggering reports. So, he has to come up with elaborate schemes. Except in real life, the schemes get you caught even faster than just filing the report would have. Banks file about 20 million CTRS every single year. That's not 20 million criminals. That's 20 million regular transactions that happen to involve $10,000 or more in cash. Construction workers getting paid for a job, small business owners depositing daily receipts, people selling used cars, grandma taking cash out of her safe to help with your down payment. All of them get reported to the federal government automatically. Structuring, the crime nobody knows they're committing. So structuring is where this gets really dark because most people who commit this crime have absolutely no idea they're doing anything wrong. Let's say you sold your used car for $15,000 cash. You think, I don't want to deal with any government reporting, so I'll deposit $7,000 today and $8,000 next week. That way, both deposits are under $10,000. Congratulations, you just committed a federal felony. The banks have sophisticated software that automatically flags this pattern. Within days, they file what's called a Suspicious Activity Report, ASAR, and now you're under investigation for potential money laundering. And here's the insane part. Even if the money is completely legitimate, even if you earned it legally and paid all your taxes, structuring itself is still a crime. The government doesn't have to prove you were laundering drug money or evading taxes. Breaking up the deposits to avoid reporting is the crime by itself. There was a famous case where a small business owner in Iowa kept depositing $7,000 to $8,000 in cash from her restaurant every few days. She wasn't trying to evade taxes. She literally just didn't want to deal with extra paperwork and thought smaller deposits were easier. The IRS seized $33,000 from her account under civil asset forfeiture, claiming structuring. It took years of legal battles to get her money back. Or look at Dennis Hastert, the former Speaker of the House. He withdrew $1.7 million from his bank accounts in increments under $10,000 to avoid reporting. He wasn't laundering drug money, he was paying someone to stay quiet about past misconduct. But the structuring itself got him prosecuted, and he served 15 months in prison. The government takes this so seriously that banks have entire departments dedicated to catching structuring patterns. Their software analyzes your transaction history looking for suspicious patterns. Multiple deposits just under $10,000? Flagged. Regular withdrawals of $9,500? Flagged. Even if you're spacing them out over months, the algorithms catch it. Suspicious activity reports, the secret surveillance. Now let's talk about SARS, suspicious activity reports. And this is where the surveillance gets way more invasive than most people realize. Banks aren't just required to report cash transactions over $10,000. They're required to report anything they consider suspicious, and that definition is incredibly broad. We're talking about behaviors that might indicate money laundering, fraud, terrorist financing, or other financial crimes. Here's what makes SARS so creepy. The bank files them in complete secrecy. It's actually a federal crime for a bank employee to tell you that you've been reported. They could go to prison for tipping you off, so you could have multiple SARS filed against you and have absolutely no idea it's happening. Banks filed about 3.6 million Saudi riyals in 2023. That's not a typo. 3.6 million reports of suspicious activity sent to the federal government every single year. And remember, the vast majority of these involve people who aren't actually committing crimes. They just did something that triggered the bank's algorithms or made a teller nervous. What triggers a SAR? The list is extensive and vague, depositing cash and immediately wiring it overseas, making large cash withdrawals with no clear purpose, opening multiple bank accounts in a short time period, receiving wire transfers from countries known for money laundering, having unusual transaction patterns that don't match your stated occupation, withdrawing large amounts before going on international trips, declining to provide information the bank requests about transactions. It's like if Matt Damon's character in The Bourne Identity tried to access his bank accounts, every unusual transaction pattern would trigger alerts throughout the financial system. One guy got flagged because he withdrew $5,000 cash every week to play poker. Completely legal activity, but the pattern triggered a SAR. Another person got reported for depositing 3 personal checks totaling $11,000 in one day. Not even cash, just checks from family members helping with medical bills. The system is designed to be overly cautious because banks face massive penalties if they miss actual criminal activity. So they report everything remotely suspicious and let the government sort it out. Better to file 1,000 false positive SARS than miss one actual money launderer. The digital payment revolution. How Venmo and Cash App report you. Now, let's talk about the digital payment revolution, because this is where surveillance has exploded in ways that would have seemed like science fiction 20 years ago. You split a dinner bill with friends using Venmo. You pay your roommate rent through Zelle. You send your kid lunch money via Cash App. Feels convenient and harmless, right? Here's what you probably don't know. These platforms are all required to report your transactions to the IRS if you meet certain thresholds. And those thresholds just got a lot lower. As of 2024, if you receive more than $600 in payments through third-party platforms like PayPal, Venmo, Cash App, or similar services, those companies must report it to the IRS on a Form 1099-K. That's $600 total for the entire year, not per transaction. Think about what that means. You sell some old furniture on Facebook Marketplace and get paid through Venmo. Your friend pays you back for concert tickets via PayPal. You do some freelance work and get paid through Cash App. If all of that combined exceeds $600 in a calendar year, it gets reported to the IRS. Now, technically, this is supposed to catch people running businesses and not reporting income. Makes sense in theory, but in practice, it means millions of personal transactions between friends and family are getting reported to the government as potential taxable income. And here's where it gets messy. Let's say your 4 roommates each pay you $400 monthly rent via Venmo, and you then pay the landlord $1,600 plus your share. You've received $19,200 through Venmo, which gets reported to the IRS as income, even though you were just collecting money to pay a bill. Now, you have to prove to the IRS that this wasn't actually taxable income. These platforms also track and analyze your transaction patterns for fraud detection. Who you're sending money to, how often, what amounts, even the memo lines you write. All of this data is analyzed by algorithms looking for suspicious patterns. Venmo faced huge backlash when people realized their transactions were public by default. Someone could look at your Venmo feed and see that you paid Dave with a pill emoji in the memo line, or paid your therapist every week, or sent someone money with rent in the description when you claim to live alone. Credit card surveillance. Every purchase is data. Let's talk about credit cards because this is where financial surveillance becomes corporate surveillance backed by government requirements. Every single credit card transaction you make creates a detailed data point. What you bought, where you bought it, when you bought it, how much you spent. Your credit card company knows if you're buying groceries at Whole Foods or fast food at McDonald's. They know if you're shopping at luxury stores or discount retailers. They know if you're buying alcohol, gambling, or visiting strip clubs. And they're analyzing all of this data constantly. Not just to catch fraud, though that's part of it. They're building detailed psychological profiles about you to predict your future behavior and assess your credit risk. Buy a lot of alcohol and make late-night impulse purchases? Algorithm flags you as higher risk. Start shopping at discount stores when you used to shop at luxury retailers? Might indicate financial stress. Suddenly buying baby products? Life change that could affect your spending patterns. It's like how in Minority Report, they predict crimes before they happen. Credit card companies are predicting your financial behavior before you make decisions. But here's where it connects to government surveillance. Credit card companies are required to report suspicious patterns to law enforcement. If you suddenly start making large, unusual purchases, especially in categories associated with criminal activity, they file SARS. What kinds of purchases trigger reports? Buying large amounts of gift cards, commonly used for money laundering and fraud. Purchasing items commonly associated with identity theft, like credit card readers or check printing supplies. Making unusual travel purchases to high-risk countries. Even purchasing large amounts of precious metals can trigger scrutiny. And credit card data can be subpoenaed by law enforcement incredibly easily. They don't need to prove you committed a crime, just that your transaction data might be relevant to an investigation. Your purchase history becomes evidence without you ever knowing. International transfers, where surveillance gets serious. Now, let's talk about international money transfers because this is where financial surveillance becomes national security surveillance. Every international wire transfer goes through what's called the SWIFT network, the Society for Worldwide Interbank Financial Telecommunication. It's basically the global messaging system that banks use to send money across borders. And the US government has direct access to SWIFT transaction data through a program that started after 9/11. They can see every international wire transfer moving through the system, where it came from, where it's going, how much, who sent it, who received it. Your wire transfer to a friend studying abroad? Tracked. Sending money to family in another country? Tracked. Paying for services from an international company? Tracked. Banks are required to file reports on international transfers over $10,000, similar to the domestic CTR requirement, but they also have to screen every single international transaction, regardless of amount, against lists of sanctioned countries, terrorist organizations, and individuals flagged by the government. This screening happens automatically in milliseconds. Your money doesn't move until the bank's compliance system verifies that you're not sending money to a sanctioned country or a person on a watch list. It's like TSA screening for money. And if you send money to certain countries, even small amounts, you're automatically flagged for additional scrutiny. Countries like Iran, North Korea, Syria, and others under US sanctions. Even tourist transactions in these countries can trigger investigations. There was a case where an Iranian American sent $300 to his elderly mother in Iran for medical expenses. The transaction got flagged, his account was frozen, and he had to provide extensive documentation to prove it wasn't funding terrorism for sending his own mother money for medicine. Cryptocurrency was supposed to solve this, right? Anonymous digital money that governments can't track? Not quite. Cryptocurrency, the blockchain surveillance. Let's talk about crypto because there's this myth that cryptocurrency is anonymous and untraceable. That's wrong, and understanding why is crucial to understanding modern financial surveillance. Bitcoin and most other cryptocurrencies aren't anonymous, they're pseudonymous. Every transaction is recorded permanently on a public blockchain that anyone can view. The blockchain doesn't list your name, but it lists your wallet address, and once law enforcement connects your identity to a wallet address, they can see every transaction you've ever made with that wallet. It's like If instead of bank statements, every financial transaction you ever made was printed on a public billboard with a masked face icon instead of your name. Sure, the icon doesn't show your face, but once someone figures out which icon is you, your entire financial history is exposed. The IRS has spent millions on blockchain analytics software from companies like Chainalysis and Elliptic. This software traces cryptocurrency flows across the blockchain, identifying patterns and connecting wallets to real-world identities. How do they connect your identity to your wallet? Multiple ways. Cryptocurrency exchanges like Coinbase, Binance, and Kraken are required to collect your identity information and report large transactions to the IRS. When you cash out crypto for regular currency, that transaction links your identity to your wallet. IP address tracking, when you make transactions, can reveal your location. Chain analysis algorithms that identify patterns and cluster wallets belonging to the same person. In 2023, the IRS added a question to tax returns. At any time during the year, did you receive, sell, exchange, or otherwise dispose of any financial interest in any virtual currency? You have to check yes or no. If you lie and they catch you later through blockchain analysis, that's tax fraud, and exchanges are required to file 1,099 forms reporting your crypto transactions if you exceed certain thresholds. Sold more than $20,000 in crypto? The exchange reports it to the IRS. Law enforcement has gotten incredibly good at tracing crypto. They busted the Silk Road, recovered billions in stolen Bitcoin, and routinely track ransomware payments. The notion that crypto provides financial privacy is largely a myth at this point. Cash, the last private transaction. So what about cash? If digital transactions are all tracked, can't you just use cash for privacy? Sure, but using too much cash makes you suspicious in itself. And the government has been working for decades to eliminate cash from the economy specifically because it's hard to track. Banks are required to file reports if you withdraw more than $10,000 cash. And just like deposits, if you withdraw amounts just under $10,000 repeatedly, that's structuring and it's a crime. There are also limits on using large amounts of cash for purchases. Try to buy a car from a dealership with $30,000 cash and watch what happens. The dealership is required to file Form 8300 reporting the transaction to the IRS. Same thing if you pay a lawyer, jeweler, or real estate agent more than $10,000 cash. And here's something most people don't know. Carrying large amounts of cash is itself suspicious and can result in civil asset forfeiture, even if you haven't been charged with a crime. Civil asset forfeiture is when police seize your money or property because they claim it's connected to criminal activity. They don't have to prove you committed a crime. They don't even have to charge you with anything. They just have to claim your money is suspicious. There are countless stories of people having cash seized at airports, during traffic stops, or at bus stations. A musician traveling with tour proceeds, a businessman carrying cash for a legitimate purchase, people who distrust banks and keep savings in cash, all had their money seized, and many never got it back because the legal costs of fighting exceeded the amount seized. It's like something out of a dystopian movie, but it's standard practice. In some states, police departments keep a percentage of seized assets, creating a direct financial incentive to seize cash from anyone they stop. The Patriot Act, how everything changed after 9/11. Now, let's talk about the Patriot Act, because this is where financial surveillance went from catching criminals to monitoring everyone. After September 11th, the government massively expanded its power to monitor financial transactions under the justification of fighting terrorism. The Patriot Act added all sorts of new reporting requirements and gave law enforcement much broader access to financial data. Banks were required to implement Know Your Customer programs, extensive procedures to verify identities, track suspicious patterns, and report potential terrorism financing. These programs cost banks billions to implement and maintain, but they also created the most comprehensive financial surveillance system in history. The Patriot Act also expanded the definition of money laundering to include any transaction designed to avoid reporting requirements. Even if the underlying funds are completely legal, even if you paid all your taxes, if you're structuring transactions to avoid reports, that's now considered money laundering. And it gave the Treasury Department power to require special measures against foreign banks they suspect of money laundering. This essentially gives the US government the ability to cut any foreign bank off from the US financial system, a death sentence for most international banks. So foreign banks comply with US surveillance requirements even for non-US citizens. It's like how in The Dark Knight, Batman uses cell phones to create a massive surveillance network across Gotham. The Patriot Act did something similar with the financial system, except it's real, and it never gets dismantled at the end. Artificial intelligence, the future of money surveillance. Now, let's talk about where this is all heading, because AI and machine learning are about to make financial surveillance exponentially more invasive. Banks are already using AI to analyze transaction patterns and predict suspicious activity with scary accuracy. These systems don't just flag specific suspicious transactions, they build comprehensive behavioral profiles and detect deviations from your normal patterns. Normally, buy lunch for $12 twice a week. Suddenly, buying lunch for $50 daily? Algorithm flags it as unusual behavior, potentially indicating financial stress or income changes. Always shopping at the same stores? Start shopping at completely different retailers? Flagged as a pattern change worth monitoring. The AI doesn't care that you got a raise and can afford nicer restaurants now, or that you moved to a new neighborhood with different stores. It just knows your behavior changed, and changes trigger scrutiny. These systems are also getting better at detecting sophisticated money laundering schemes that humans would miss. They can trace money flows across hundreds of transactions and dozens of accounts to identify layering schemes, where criminals move money through complex paths to obscure its origin. But the same technology that catches money launderers also monitors everyone else. AI doesn't distinguish between suspicious because potentially criminal and suspicious because unusual. It flags both, and then human analysts decide which to investigate further. And AI systems are increasingly being integrated across different financial institutions and government agencies. Your transaction patterns at Bank A get analyzed alongside your credit card usage and your tax returns and your international transfers, creating comprehensive financial profiles that no single institution could build alone. How to stay private in a surveillance world. So what can you actually do if you want financial privacy in this surveillance environment? First, understand that true financial privacy essentially doesn't exist anymore in the modern banking system. Every significant transaction leaves digital footprints. Accept that reality before making plans. For legal privacy, your best options are: use cash for small transactions you don't want tracked. Be aware of reporting thresholds and don't try to structure around them. Just accept the reports. Keep detailed records of all large cash transactions with documentation showing legitimate sources. Use multiple banks for different purposes to avoid concentration of data. Be cautious with memo lines in digital payments. Never joke about illegal activities. Understand that using privacy tools like cryptocurrency or offshore accounts often creates more scrutiny than it avoids. For crypto, use privacy coins like Monero if you want actual privacy, but understand these are heavily scrutinized, and remember that eventually you have to convert back to regular currency, and that's when your identity gets linked to everything. For international transactions, use proper channels and keep documentation. Trying to avoid reporting requirements causes way more problems than just filing reports and explaining legitimate purposes. The most important thing is to never try to evade reporting requirements or structure transactions to avoid thresholds. The crime of trying to avoid surveillance is often worse than whatever you thought you were hiding. The conclusion. So that's the modern financial surveillance system. CTRs for cash over $10,000. SARs for anything banks consider suspicious. IRS reporting for digital payments over $600. Credit card transaction analysis. International transfer monitoring. Blockchain surveillance. AI systems analyzing patterns. All of it feeding into government databases tracking how you spend every dollar. The system was built to catch money launderers, drug dealers, and terrorists, but in practice, it monitors everyone and flags millions of completely innocent transactions as suspicious every year. The government and financial institutions can see nearly every financial transaction you make, where you shop, what you buy, who you send money to, where you travel, and how your spending patterns change over time. All of it tracked, analyzed, and stored in databases that law enforcement can access with a subpoena. Is this system catching criminals? Absolutely, but it's also creating the most comprehensive financial surveillance network in human history, monitoring hundreds of millions of people who will never commit financial crimes. Welcome to the Panopticon. Every transaction is watched, every pattern is analyzed, every deviation from normal triggers scrutiny. If you want to understand how criminals actually move money without triggering all this surveillance, I've got a video on every money laundering tactic they use, link in the description. Thanks for watching. Spend carefully out there.